Welcome to ATFTV. This is Christine Zhou reporting from London. Today we have with us experienced bond investor Rajeev De Mello, who joins us from Singapore. Welcome back, Rajeev.
Well, thank you, Christine, for having me on your show. Great to be back on.
Rajeev, defaults in China have picked up significantly in the last year, and even SOEs are not being bailed out by the government. What are the implications for these bad debt, and how are they being priced in regards to bond investments?
Yeah, China has allowed the market mechanisms to function a bit more in the credit space. In the past 10 years or 15 years, we were used to a very low default rate in China, especially in state-owned enterprises. In the last couple of years, China has really wanted to introduce more market mechanisms into the credit pricing. It's wanted to avoid a moral hazard problem. It's quite a challenge with the pandemic ongoing. But I do expect that default rates will continue to rise at a controlled rate. The central government's not going to want to let things get out of hand, but at the same time, it does want to avoid a moral hazard problem and financial instability down the road. So investors have to get used to a higher default rate. I think a lot of it is priced in already. And so I'm not so worried that it will contribute to systemic risk to the credit market in China. But of course, investors have to be careful, which SOEs bonds they buy, who is guaranteeing them or supporting them. Is it a local government far away from Beijing, or is it very close to the central government? But yes, investors should expect a gradual rise in default rates.
As the Fed is likely to keep rates low for some time going forward, what are the implications for high yield and local currency debt, even as the negative yielding debt pile has climbed to over 18 trillion?
That's amazing. 18 trillion is an absolutely staggering number. And it really forces investors to take more risk in various markets. So as investors are not comfortable owning negative yielding bonds for too long, maybe briefly thinking they might go more negative, but afterwards there's very little interest. So they've got to go and take risk elsewhere. So the Fed will stay low for a long time. There's no likelihood in my mind that we see any type of monetary policy tightening in 2021. So investors are going to be pushed into all kinds of bonds, which and asset classes, which are riskier, and that's something which will continue. When we saw that big move in the last couple of months, as investors really bought a lot of different risky assets, including in the tail end of 2020, with the incredible surge in even cryptocurrencies.
After the shortest bull market in its history, U.S. stocks rallied hard last year, with both the S&P and Dow Jones hitting new highs, on the Nasdaq posting its biggest annual gain since 2009. Given that backdrop, what are your expectations for U.S. equities this year, and how would other equity markets be impacted by this?
Yeah, for many investors, it seems that valuations have reached a very expensive level. And so they're worried that after the tremendous performance that we had this year, something is going to disrupt the rally. And, it's not the time to get in. However, despite the very high valuations, the critical point is that bond yields are so low. With negative bond yields, as well as very low bond yields, really dominating government bonds and investment grade bonds as well. Investors have to find somewhere to put their money. There is a slight rise in inflation. Inflation expectations have been inching upwards. And at the same time, there's a commitment by central banks to keep rates low. The Fed has formalized a change in its framework where it will let inflation go up before it does anything. In fact, it'll let inflation go up beyond 2% to catch up for lower inflation in the past couple of years. The ECB is going through a review itself and will probably come out with a similar conclusion. So with central banks tolerating modestly higher inflation, there will be very little moves on their side whatsoever in the next couple of years.
Thank you, Rajeev, for the insightful information today. We look forward to having you back with us again.
Well, thank you for inviting me, Christine. Great to be on your show.
And thank you everyone for watching. Do please check out asiatimesfinancial.com for the best Asian news on markets, economies, and more. I'm Christine Zhou reporting for ATFTV from London.